There is something profoundly unsettling about walking through a major downtown financial district right now. If you look up, the skyline hasn't changed. The glass towers are still there, the steel structures still reflect the sun. From the outside, they project an aura of absolute, unshakable wealth. But if you actually stop and pay attention, it's the silence that gives it away. Inside these buildings, elevators are running empty cycles. Entire floors are completely dark. The marble lobbies are empty by 2 p.m. These structures are no longer monuments to commerce. They are massive, bleeding liabilities. And yet, somehow, on paper, they are still valued at hundreds of millions of dollars. Here is the uncomfortable reality that the financial sector is currently pretending isn't happening. Over the next 3 years, more than $3 trillion in commercial real estate loans are coming due. The math is brutally simple. These loans were made when money was virtually free, and these buildings were packed. Today, interest rates have doubled, the buildings are a quarter empty, and the regional banks holding the paper are sitting on catastrophic, unrecoverable losses. Most financial commentary talks about the commercial real estate crash as if it's an approaching storm, something we might still dodge. But that's a fundamental misunderstanding of the modern banking system. The reckoning isn't coming. The money is already gone. The crash has already happened. It is just sitting quietly on the balance sheets, legally hidden, waiting for the clock to run out. To understand why this system is fracturing, we need to step away from the empty lobbies for a second and look at the actual math. And honestly, this is the uncomfortable part, because most of us view debt through the lens of a traditional residential mortgage. You buy a house, you lock in a 30-year fixed rate, and as long as you make your monthly payment, you are entirely insulated from whatever the Federal Reserve does. If interest rates spike tomorrow, your mortgage payment doesn't change. Commercial real estate does not work that way. It operates in an entirely different financial universe, one built almost exclusively on 5 to 10-year interest-only loans. When a corporate developer buys a skyscraper, they aren't slowly paying down the principal over 3 decades. They are just paying the interest. And at the end of that short 5 or 10-year term, they face what's called a balloon payment. The entire massive principal is suddenly due all at once. Of course, nobody actually pays off a $100 million balloon payment in cash. They simply refinance it into a new loan. It's a perpetual debt machine, and it functions perfectly, but only under 2 very specific conditions. Money must remain cheap, and the building must remain full. But here's the part most people miss. Both of those foundational conditions just evaporated at the exact same time. Let's look at the brutal reality of the numbers. Imagine a mid-sized office building purchased in 2018 or 2019. Back then, it was 95% occupied. It was financed with a commercial loan at around 3%. In that environment, the rent easily covered the debt service, generating a healthy, predictable cash flow for the owners. Fast forward to today, that loan has reached its maturity date. The debt must be rolled over. But the new rate isn't 3% anymore, it's 7% or 8%. And thanks to a permanent cultural shift in how corporations work, that building is no longer 95% occupied. It's sitting at 70% or maybe 65%. Think about what this implies. Your cost of capital just doubled, while your primary source of revenue dropped by a third. The building no longer generates enough rent to cover the new interest payments. It isn't just a little less profitable, it is mathematically insolvent. You cannot negotiate with a math equation. It doesn't matter how prestigious the address is. If the yield is negative, the building is a dead asset. In 2008, we watched the financial system fracture because millions of individual homeowners couldn't afford their adjustable rate mortgages. The rot was retail. It was scattered across suburban neighborhoods. Today, the rot is institutional. The toxic assets aren't $300,000 houses, they are $300 million glass towers. And the sheer scale of this is staggering. We are staring at a refinancing tidal wave of over $3 trillion hitting the market between now and 2027. It's a wall of debt that mathematically cannot be cleared. Whenever you bring up the severity of the commercial real estate crisis, there is almost always one immediate response. You hear it from local politicians, you read it in major financial op-eds, and honestly, it is probably the exact thought that has crossed your mind. Why not just turn all these empty offices into apartments? It sounds incredibly elegant. We have a massive housing shortage in this country, and simultaneously we have millions of square feet of empty, climate-controlled space sitting idle. Problem solved, right? It feels like a perfect common-sense solution. But here is the part most people never realize until they actually look at the blueprints. Converting a modern office tower into residential housing isn't a simple renovation. In the vast majority of cases, it is a structural and mathematical nightmare. Pause for a second and think about how a typical 1980s or 1990s glass office building is actually designed. They have what architects call deep floor plates. This means the distance from the exterior windows to the very center of the building is massive, sometimes 60 to 80 feet deep. When a building is used for office space, that's perfectly fine. You put the desirable cubicles and executive suites by the windows, and you use the dark, windowless center for elevator shafts, copy rooms, and storage closets. But residential building codes and basic human psychology require bedrooms to have windows. You cannot legally or practically lease an apartment where the bedroom is a dark, windowless cave 50 feet from the nearest source of natural light. Because of this simple geometry, you end up with an enormous dead zone in the center of the building that generates absolutely zero rental revenue. And then we get to the plumbing. This is where the logic begins to completely break down. An entire floor of a commercial skyscraper designed to hold maybe 100 workers typically relies on one centralized bathroom core, a men's room, a women's room, maybe 4 or 5 toilets, and a few sinks. Now, imagine dividing that exact same floor into 20 individual apartments. Suddenly, you don't need one centralized water source, you need 20 kitchens, 30 bathrooms, 20 washing machines. You need pressurized water supply lines and gravity-fed drain pipes crisscrossing the entire floor. To do that, construction crews have to core drill hundreds of new holes through thick, post-tensioned concrete floors. If they hit a structural steel cable while drilling, the entire floor's integrity is compromised. And even if they don't, the sheer cost of completely re-engineering the HVAC systems, the electrical grids, and the plumbing is staggering. When developers actually sit down and run the math, they discover something deeply unsettling. It is very often more expensive per square foot to gut and retrofit an empty glass office tower than it is to simply bulldoze the entire property and build a brand new apartment complex from scratch. To be fair, there are exceptions. Narrow, pre-World War II brick buildings from the 1920s often convert beautifully into lofts, but those aren't the buildings defaulting right now. The toxic assets currently rotting on bank balance sheets are the massive, generic glass boxes built over the last 40 years. Personally, this is where the official narrative starts becoming difficult to trust. Why do financial networks keep pushing this conversion myth? Because the alternative is admitting that a massive portion of the commercial real estate market is functionally obsolete. It's a comforting fiction, but it doesn't change the reality. These buildings are stranded assets, and because they cannot be magically saved by turning them into housing, the regional banks holding the loans are trapped. If we accept that these buildings cannot magically become apartments, and we know that the current rent cannot possibly cover the new 7% interest rates, logic dictates that a massive wave of defaults should be happening right now. You would expect to see foreclosure signs taped to the glass of half the skyline, but we don't. And this is where the story gets incredibly dark. To understand why the system hasn't officially collapsed yet, you have to look at the accounting loopholes that banks are currently using to hide the bodies. In the financial industry, there is a very quiet, very deliberate strategy being deployed right now. It's called extend and pretend, though some bankers jokingly refer to it as delay and pray. Here is how it actually works. Let's go back to our insolvent office building. The developer knows they mathematically cannot refinance the balloon payment. They walk into their local regional bank and say, "I can't pay. Take the keys, foreclose on the building." Now, common sense tells you the bank would be furious, but the reality is the bank is terrified. If the bank accepts those keys, they take ownership of the property, and under strict accounting rules, the moment they take back that building, they have to value it at today's true market price. That glass tower they loaned $100 million against, today, empty and with high interest rates, it might only fetch $40 million at a distressed auction. If the bank acknowledges that $60 million loss, it takes a direct, fatal hit to its core capital. Multiply that loss across 50 different office buildings in their portfolio, and suddenly the bank is entirely insolvent. They would be seized by the FDIC by Friday afternoon. So, what does the bank do? They look at the developer and say, "Keep the keys. Let's just pretend this loan doesn't expire for another 3 years. We'll extend the maturity date. Just pay whatever interest you can." They extend the timeline, and they pretend the asset is still worth $100 million. At first glance, this seems harmless. It feels like extending grace to a struggling business. But if you step back and look at the incentives, you realize this isn't grace, it is institutional fraud, legally sanctioned by a system terrified of a panic. By refusing to mark these buildings to their true value, banks are turning massive commercial loans into zombie debt. The loan is dead, the underlying asset is dead, but on paper it is still counted as a living, performing asset that props up the bank's stock price and executive bonuses. You might be wondering, why do regulators allow this? Why doesn't the Federal Reserve or the FDIC step in and force them to come clean? Because the alternative is admitting systemic failure. Regulators know that if they force one regional bank to mark its commercial real estate to reality, they have to force all of them to do it. The contagion would be immediate. So they look the other way. They quietly alter the reporting rules, hoping that maybe magically interest rates will plummet back to zero before the music stops. Historically, we know exactly how this ends. In the early 1990s, Japan experienced a massive real estate crash, but instead of letting the bad debts clear out of the system, Japanese regulators allowed their banks to do exactly this, to hide the bad real estate and keep them on the books at inflated values. They created what economists call zombie banks. What happened? It paralyzed their entire financial system. Because banks were secretly sitting on billions in toxic waste, they had no capital to lend to new, healthy businesses. It led to Japan's infamous lost decades, 30 years of economic stagnation from which they still haven't fully recovered. And right now, the U.S. banking sector is quietly replicating that exact model. What makes this dangerous is how invisible it feels. Most people never notice this happening in real time. You don't see bank runs every day, so you assume the banks are healthy, but the rot is there. It is just being masked by accounting tricks, waiting for a catalyst to expose the underlying insolvency. And the most concerning part, this toxic waste isn't primarily held by the massive megabanks on Wall Street. It's sitting in the vaults of the very banks that run Main Street. Now, you might be tempted to think, well, I don't own a skyscraper. I don't invest in commercial real estate funds. Why should this keep me awake at night? And honestly, if this debt was sitting on the balance sheets of the too-big-to-fail giants, the JP Morgans or the Bank of Americas, the system could probably absorb the blow. Those banks are massive, highly diversified, and they've spent the last decade being forced by regulators to hold huge piles of just-in-case cash. But that's not where this crisis is living. Think about it this way. The massive Wall Street banks have been quietly backing away from office loans for years. They saw the writing on the wall. But the local regional banks, the community lenders, the banks that sponsor your local Little League team, they didn't have that luxury. To them, commercial real estate wasn't just an asset class, it was their bread and butter. Today, mid-sized and small regional banks hold roughly 70% of all outstanding commercial real estate debt. Let that number sink in for a moment. 7 out of every $10 lent to office developers came from the banks that hold the working capital of Main Street America. These banks are hyper-localized. Their entire survival is tied to the health of the very downtown cores that are currently hollowing out. This creates a terrifying concentration of risk. If you're a regional bank in a city like San Francisco, Chicago, or Atlanta, and your loan portfolio is 40 or 50% tied up in local office space, you aren't just exposed, you are sitting on a powder keg. We've already seen how this movie ends. In early 2023, when Silicon Valley Bank and First Republic collapsed, the world was shocked by how fast it happened. In the digital age, a bank run doesn't take days of people standing in line on the sidewalk. It takes 30 seconds on a smartphone. Trust is the only thing keeping a bank alive, and in the current environment, trust is in incredibly short supply. When depositors start realizing that their local bank is hiding zombie debt from empty office buildings, they don't wait for a formal audit. They move their money to the too-big-to-fail institutions where they think it's safer. This triggers a liquidity crisis. The bank is forced to sell its assets to raise cash, and because those assets, the office loans, are worth 60 cents on the dollar, the bank's insolvency is suddenly violently exposed. This is what makes the situation so precarious. It's a circular trap. The banks can't admit the buildings are worth less because they'll go under, but because they won't admit it, the market grows more suspicious every day. It's not just about wealthy developers losing their shirts. It's about the institutions that provide the credit for small business payrolls, local construction, and personal lines of credit. If the regional banking sector freezes up under the weight of these empty towers, the oxygen is cut off for the entire local economy. This isn't a Wall Street problem. This is a Your Street problem. And because of that, you cannot afford to be a passive observer. So, where does this leave you? It is very easy to feel like a passenger on a ship with a failing engine, just waiting for the inevitable. But while you can't change the Federal Reserve's interest rate policy or fix the plumbing in a 40-story office tower, you are not helpless. This isn't about being paranoid. It's about being a cold, rational steward of your own capital. The first step is the most obvious, yet it's the one most often ignored: the FDIC limit. If you're in the U.S., that limit is $250,000 per depositor per bank. If you're a small business owner or an individual sitting on a balance higher than that in a single regional institution, you are effectively an unsecured creditor to that bank. You are betting your financial future on their ability to manage a commercial real estate crisis they didn't see coming. Spread your risk. Secondly, you need to perform your own financial autopsy on your bank. You don't need to be a CPA to do this. You can look up a bank's call report. It's public data. Look specifically for their commercial real estate concentration ratio. If a bank's commercial real estate loans exceed 300% of its total risk-based capital, regulators consider them high risk. If your bank is in that category, you deserve to know why. Finally, consider the systemically important cushion. While we often criticize the big guys, too big to fail giants for their role in the global financial machine, they are held to a completely different standard of liquidity. Moving a portion of your operating cash to a larger, more diversified institution isn't abandoning your community bank. It's basic risk management. This crisis isn't going to be a single big bang event. It's a slow, quiet leak that eventually turns into a flood. By the time the mainstream media is running breaking news banners about a regional bank failure, the exits are already crowded. The math is telling us exactly what is coming. The question is whether you're going to wait for the official announcement or if you're going to act while the silence is still in your favor.